Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, let's unpack this. We have to start with the transformative news, which seems to be dominating the entire narrative right now.
Absolutely. The definitive agreement to acquire Ask Sage.
And this isn't just some small bolt-on acquisition, is it? This feels like a major strategic pivot.
It is. It's a complete pivot. You know, BigBear.ai has historically been mostly a systems integrator, a project-based business.
Right.
Ask Sage just changes the entire game. We're talking about a cutting-edge generative AI platform built specifically for defense and other highly regulated sectors. And that's really the key here.
What makes it so critical, though? Why is this specific acquisition getting so much focus? What's the competitive advantage they're buying?
It all comes down to the regulatory moat. Look at what they bought. Ask Sage is one of the only model-agnostic GenAI platforms that holds FedRAMP High accreditation.
Okay, we hear that term a lot, but for someone listening who might not be deep in government contracts, what does FedRAMP High actually mean for a company like this?
Think of it like this. It's the highest level of security clearance for software that operates in the cloud. It means the platform is cleared to handle the government's most sensitive, unclassified data. Data that, if it got out, would have severe consequences.
So it's a huge barrier to entry.
A massive one. Getting this accreditation is a multi-year, incredibly complex, and very expensive process. It keeps almost everyone else out of those really lucrative, really sensitive government contracts. That's a stamp of approval.
And they already have customers baked in, I hear. They aren't just starting from zero.
Exactly. That's the other key. They're not building from scratch. Ask Sage already serves over 16,000 government teams.
16,000.
Yeah, across 27 different agencies. We're talking the U.S. Space Force, the Army's Enterprise LLM workspace. They're buying an established, accredited, deployed software platform, not just a concept.
That installed base sounds fantastic. So let's talk numbers. This couldn't have been cheap. What did they pay, and what kind of growth are we looking at?
They're paying $250 million.
Yeah.
And the number that really matters here is the annual recurring revenue, or ARR.
Okay.
Ask Sage's ARR is tracking toward $25 million in 2025. And get this, that's a six-fold increase from 2024.
A six-fold increase.
Yeah.
Wow.
And that accelerated, predictable revenue stream is exactly what BigBear.ai needs to drive future margin expansion.
All right, so that paints an extremely bullish picture for the future, but we have to ground this in what's happening right now.
Right.
The third quarter results that came out with this news, they seemed a little mixed, didn't they? The headline revenue was a bit soft.
You are absolutely right to bring us back down to earth, because while the acquisition is transformative, those Q3 results really show the challenges in their current core business.
So what were the numbers?
Revenue for the quarter came in at $33.1 million, which, to be fair, did beat the consensus expectation of around $31.8 million.
So an earnings beat is a positive, but that number, the $33.1 million, it feels like it hides some of the near-term pain.
It does. It was a 20.1% decline year over year.
20%, that's significant.
Very. Management said it was mainly due to lower volume on certain legacy Army programs. It shows they're in a bit of a cyclical trough with government spending right now.
So if that core revenue is down, where does the company stand financially? I mean, a $250 million deal, that takes deep pockets.
And this is where the story gets really, really interesting. This is how they could afford it.
Okay.
Despite the revenue challenges, BigBear.ai has an exceptionally strong balance sheet. A real fortress, you could say. They reported a record cash and investments balance of $715 million at the end of Q3.
$715 million in cash.
In cash and investments, yes.
For a company with a market cap around, $2.8 billion, that's a huge cushion. That liquidity is clearly what made the Ask Sage deal even possible.
Precisely. And they also have a substantial backlog of secured future revenue. They stand at $376 million. So the work is lined up. It's just a matter of timing.
But let's talk profitability for a second, because if they're trying to pivot to software for margin expansion, what do the current margins look like?
The margins are definitely under pressure. Gross margin declined to 22.4% in Q3. That's down from almost 26% the year before.
And that's that systems integrator work you mentioned?
Exactly. It's labor-intensive. They have engineers on site for these projects, and that's expensive. It eats into the margins. Adjusted EBITDA was negative $9.4 million.
So essentially, they have a giant pile of cash and a big book of future work, but they are currently burning money on their core operations.
That's a perfect summary. The market is not valuing them on current profits at all. It's a bet on that cash pile and the future potential of Ask Sage. It's pure projection.
Which brings us to the other half of this story, the market mechanics. Because even with this huge strategic acquisition news, the stock has been incredibly volatile. I mean, we saw a dramatic price drop down toward that $5.50 range.
Yes, and that defies fundamental logic, right?
Yeah.
You announce great news, and the stock tanks.
Exactly.
Which is why the chatter in the market is all about something much more aggressive than just, profit-taking. The theory is a calculated algorithmic attack, a liquidity trap.
A liquidity trap. Okay,
Yeah.
break that down for me. How does that work here?
Well, the theory is that the good news, the Ask Sage acquisition, was used as bait.
Baits.
Yeah, to bring in a huge wave of retail buying. Push the price up over $6. Institutions just let that enthusiasm build.
And then at the peak, around $6.15, what's the alleged move?
That's when they supposedly short into strength. Right at the peak of all that buying, they initiated massive short positions, just overwhelming the upward momentum and crushing the price.
But couldn't that just be opportunistic trading? What's the so-called smoking gun that suggests it was a pre-planning act?
The evidence that's often pointed to is a specific SEC filing. It's a Form 144 from a few days earlier on November 18th.
A Form 144. What is that, and why is the timing so important?
So a Form 144 is just a public notice. It's filed by company insiders or affiliates when they intend to sell a large number of restricted shares.
Okay.
The argument is that filing this document days before the news hype peaked shows the intention to sell was already locked in. They were just waiting for that price spike to give them the perfect exit.
That's a pretty strong suggestion, but selling that much volume, wouldn't that crash the price instantly on a public exchange? How do they control the drop?
And that takes us into the plumbing of the market. Dark pools. Reports claim that over one-third, 33% of the entire day's trading volume happened in dark pools.
A third of all the volume hidden from public view.
Exactly. Dark pools let these large institutions offload huge volumes of shares without the price immediately collapsing on the public exchange. It's all about stealth. And the goal wasn't just profit on the short, it was strategic.
What was the strategic goal?
Breaking that key $5.50 support level.
Why that level specifically?
It's all about liquidity harvesting. A lot of retail traders set their automatic stop losses just below a key psychological level like $5.50.
So if the institutions can push the price just below that, it triggers a cascade of forced selling.
A cascade. And that forced selling creates cheap shares for the shorts to then buy back and cover their positions for a massive profit. The whole game is about forcing those retail shares out cheaply.
That puts all the volatility into a completely different context. Now, let's zoom back out. The comparison that always seems to follow this stock is to the industry giant, Palantir.
Yes.
Is BigBear.ai really the next Palantir?
I mean, the honest answer, based on the metrics, is that the comparison is very, very difficult to justify right now.
Why is that? Scale.
Scale is a huge part of it.
Yeah.
BigBear.ai's Q3 revenue was $33.1 million. Palantir's was $1.18 billion. The gap is it's massive, and Palantir's growth is much faster.
And beyond just the size, you keep mentioning the margins. That seems to be the core difference in the business model.
It is the core difference. BigBear.ai's gross margin is stuck down at 22.4% because it's a service-heavy systems integration model. Palantir, on the other hand, operates on a high-margin software model.
Selling a platform.
Exactly. They sell a scalable, pre-built platform. It allows them to get gross margins above 80%. It's a whole different ballgame.
And what about customer concentration? That seems like another big risk.
It is a major concern, yes. 4 major clients make up 52% of BigBear.ai's revenue. That's a huge vulnerability if a contract shifts, which is what we saw with the Army programs. Palantir is far more diversified.
So given all that, the volatility, the low margins, the concentration, what does this mean for its valuation?
It means it's trading at a very high valuation relative to its current fundamentals. I mean, they're guiding for 2025 revenue to actually decline from 2024.
A decline.
Yes. Analysts are projecting a rebound of around 30% in 2026, driven by Ask Sage, but for now. It's viewed by many as highly speculative, an investment in future potential, not current reality.
So, with that speculation and these alleged attacks, the technical levels must be critical for anyone watching this.
They are everything right now. And the battleground is that $5.50 level.
That's the key support to watch.
It's the critical support. If the price holds or bounces hard off of $5.50, that's a signal that smart money is stepping in against the short attack.
What if it dips just a little bit below, say to $5.45? Does that mean the shorts have won?
Not necessarily. That's the classic move. It's called a stop-loss hunt or a shakeout.
Okay.
Shorters will deliberately push the price just under support to trigger all that automated selling before quickly reversing it. It's a pure psychological move.
So what's the signal that the tide has truly turned? What's the resistance level they need to break?
For a solid reversal, the next major hurdle is the range between $6 and $6.15. What you want to see is a sustained 4-hour candle close above $6. That suggests the buying pressure is real and has absorbed all that selling.
Looking ahead then, beyond the day-to-day chart watching, what are the primary catalysts investors should be focused on over the next, say, 3 to 6 months?
Number one is the official closing of the Ask Sage acquisition. That's expected late Q4 or early Q1 2026. That's when the real integration begins.
And then I assume the next earnings report to see if the 2026 growth story is on track.
Exactly. The Q4 earnings release will be absolutely essential to validate that growth trajectory. And finally, you have to watch the federal budget.
Defense appropriations.
Absolutely. Any news on that, especially early in 2026, could accelerate new contract awards and start working through that big backlog they have.
It sounds like this is a company in, well, an extremely volatile transition. They're using a massive cash position and this key acquisition to pivot away from cyclical government work toward durable AI platform growth.
The entire bullish case really hinges on Ask Sage driving that margin expansion and on them successfully executing that $376 million backlog. But the ultimate takeaway for you, the listener, is this. Are you investing in the promise of the future software platform? Or are you investing in the risk profile of the current low-margin systems integrator? You have to decide if that massive cash cushion is enough to buy them the time they need to make that shift.
Excellent analysis. We'll be tracking all those moving parts closely. To stay ahead of the next market catalyst, make sure you subscribe, like, and comment below. We'll see you next time on Smart Wealth with Joshua.